FedEx Corporation, stock ticker FDX, is currently trading at $208.72 per share. Now, this is a company that actually wasn't on my dividend stock watch list for quite some time, but after reviewing some articles on Seeking Alpha, I noticed a couple of different points that did make me interested in the company. Now, if we come over here, we can see over the past year, they're down almost 22%, and year to date, they're down almost 20%. So in this video, we're going to be jumping into my stock analysis and valuation spreadsheet to see if we can find the intrinsic value of FedEx and decide if it's a stock we should be buying or selling. And on this spreadsheet, we have our 4 different valuation models. We have Graham's valuation, we have a discounted cash flow model, a multiples valuation, and our dividend discount model. And all 4 of these valuations will roll into our output tabs. Let's go ahead and jump back over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here. And the first thing we need to do is plug in the stock ticker for FedEx and hit enter. And once I do that, you can see all of this data is going to automatically load in. Now, we're currently looking at a 500-day chart, and we can see it's down quite a bit from its all-time highs, and it's been a little choppy as of late. Let's go ahead and zoom in a little bit more. We'll look at a 1-year chart, so I'll type in 365, and we can just see, like I said, it's been quite choppy. Now, if we come over here and look at the dividend data, they're currently paying out $4.60 per share, which gives them a dividend yield of right at 2.2%, so not a super high dividend yield, but it is a little bit better than the average company within the S&P 500. Now, again, current trading price 208, down pretty large 1 and just 7% over the past 2 years. Now, analysts do currently have a target price of $290 per share for this company, quite a bit higher than the current price. The last thing we do want to glance at is the beta right here. As we can see, a beta of 1.21, so that means this company is going to be a little bit more volatile than the market overall. But let's go ahead and jump into our first valuation model, and that's going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham, who is one of Warren Buffett's mentors, and this is the formula he laid out for us to calculate intrinsic value. So we're going to plug all of these variables in. The first one we need is the earnings per share, which you can see we have listed right here. We're then going to multiply that by 7, which is the price to earnings of a company with no growth. We then multiply that, we then add our growth rate projection to that, which you can see for this company. I did some research on industry expectations and analyst expectations, and I'm applying a growth rate of about 11.5. That's what most people are expecting. We then multiply this by 4.4, which is the average yield of AAA corporate bonds. Once we've done all of that, we divide by Y, which is the current yield of AAA corporate bonds. At the time of this video, it's higher than I've seen it be in quite some time at 4.41. But once we plug all this in, we can see the intrinsic value is $265 per share, quite a bit higher than that current trading price. Now, keep in mind, the current yield of AAA corporate bonds was quite a bit lower earlier this year. It was as low as about 2.8. If you make that change, we can see that intrinsic value jumps up pretty drastically, but as of now, it is sitting at 4.41, so I'll go ahead and put that back, and we can see again, intrinsic value of 265 with Graham's valuation. But let's go ahead and jump over to what most people consider one of the best ways to value a stock, and that is the discounted cash flow analysis model. So in order to perform a discounted cash flow analysis, we need to project a growth rate to the future free cash flows of the company. So in order to do this, I plug in the historical free cash flows as we can see right here, and this allows me to see growth rate percentages year over year. Now, the first thing you'll notice is we have very volatile and kind of jumps around with the free cash flow. We can see really high free cash flow, really low free cash flow. It jumps around quite a bit, but what you will be able to notice is, we were sitting pretty low right here, but if we look at 2020 and 2021, it is much higher than it was about 5 years ago. So while the average growth rate doesn't really show a true average growth rate that we should expect, we can see that the free cash flow is growing. And so after looking at industry expectations, analyst expectations, and doing my own research, I'm applying a growth rate of 11% to the future free cash flows of the company, which you can see right here. I also use it to project the terminal value, which is the sum of the future free cash flows past the year 2030. I then found the present value of these future free cash flows and added them all together here. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value. Once I had the equity value, I divided by the number of shares outstanding to get my discounted cash flow price per share of $278, and that's again a bit higher than the current trading price, and it's also pretty close to the valuation we came to with Graham's valuation. Let's go ahead and look at our next valuation model, which is the multiples valuation. Now, this is a pretty solid valuation model. It's used in certain circumstances, but essentially the idea behind it is we should be able to value a stock based on how the market is valuing other companies similar in structure to the company we're trying to value using a multiple. And in this scenario, we're using a price to earnings multiple. So let me show you how this works. We're taking companies, again, similar to FedEx. We're taking their stock price and dividing by the earnings per share to find the price to earnings multiple. Once we've done this for a few companies, we take the average price to earnings multiple for those comparable companies, and we multiply that by the earnings per share for FedEx. And this gives gives us an intrinsic value of close to $250 per share, which again means we have a higher intrinsic value than the current trading price. So what this means is we can see average price to earnings for these comparable companies, 16.6. If we jump back over to the stock screener, and we can look at FedEx's price to earnings, we can see it's a little bit lower than their competitors. So sometimes there's a reason behind this, but I think in this scenario, it could be an indicator that this company is slightly undervalued. But let's go ahead and look at our last valuation, which is the dividend discount model. Now, if you're like me, I'm a value dividend investor, so this is a very important valuation model for me to look at. It's going to help me understand how their future dividends are going to grow and what their current dividend yield is. So essentially, the idea behind our dividend discount model is we want to be able to value a stock based on how much they pay out in dividends and how much that dividend increases. So what we do is we plug in the quarterly dividend payouts over the past few years so we can see exactly how much they pay out yearly, and this allows me to see year-over-year growth rates. Now, the first thing you'll notice is not a great sign here. We can see they had a few years around 2020 where they didn't have any dividend growth whatsoever, but that changes pretty big over the past couple of years. We can see they had a huge increase right here of almost 15 to 16%, and then a ginormous increase in their dividend payouts at over 50% this most recent dividend cycle. Now that is pretty unbelievable. That's a sign of a very healthy company. So the average growth rate over the past few years is 17.18. Obviously, it's pretty high due to the most recent dividend increase, but moving forward, I'm projecting a growth rate of 5.5% for this company. That's pretty high when you consider it is for the entire lifespan of the company, and so that's a pretty solid dividend growth rate. Now, I am applying a discount rate of 8%. Once we plug all of this in, you can see this is the formula we use to calculate the intrinsic value, and it gives us $194 per share. Now, anytime you do apply a high growth rate projection to using the dividend discount model, something you do want to do is jump over to our stock screener and check that payout ratio. And we can see here payout ratio of just 20.7%. So the fact they're able to increase their dividend payouts by such a large amount and their payout ratio is still sitting at just 20%, that is a sign of a very healthy company and a very healthy dividend program that they have. Now let's go ahead and jump over to our output tab, and here we can see all four of our valuation models. Grams at 265, multiples at 249, discounted cash flow at 278, and dividend discount model at 194. Now when we average all four of these together, we come to an intrinsic value of $246.68 per share. Now the current trading price for this company is about $208.72 per share. Now as a value dividend investor, we do always want to apply a margin of safety to our investments. So let's say we're a little bit aggressive with our margin of safety when we only apply 10%. Based off of that, our acceptable buy price for this company would be $222, meaning this is a company that we should be buying under this current trading price. Now, for a little bit safer, and let's say we want to apply a 30% margin of safety, I'll hit enter. We can see based off of that, our acceptable buy price would be about $172 per share, meaning this is not a company we should be currently buying. Now, as for me, this is definitely a company I'm going to put on my dividend watch list. When I saw the dividend growth over the past few years, I thought that was absolutely phenomenal to see their management making that a priority, but it's even better when you consider the fact their payout ratio is still just at 20%. That means they're going to continue to be able to grow their free cash flow, which is a great sign for business growth, growth for the business as a whole, and as they continue to increase their dividend payouts. So again, as for me, they'll definitely be on my watch list. I'll consider buying them in the future, but go ahead and let me know in the comments down below what you think of this company and if you plan on buying or selling. But with that being said, if you guys like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. And please don't forget to like and subscribe to the channel.